Principal and interest payments versus interest only. How big will this affect your cash flow? In today's video, I'm going to analyze principal and interest versus interest-only payments, and I want you to see the major difference this will have on the cash flow of your asset. If you're new to the channel, my wife Mel and I have purchased over 240 units in 5 different countries: US, Canada, Costa Rica, Mexico, and Dominican Republic, and we do all that with creative financing and no joint venture partners. We drop a new video every single week, so make sure to subscribe to the channel and hit the bell to get notified so you get more good stuff like this. All right, now let's get into the good stuff. I want to talk about principal and interest versus interest-only payments, and I'm going to build out a scenario for you, okay? So here, let's take a $500,000 purchase price, okay? And let's do 75% loan to value, which would be, right, 75% loan to value is $375,000. So this will be your first mortgage. This will be what the bank will lend to you, and I'm doing some easy math here. I am assuming a 5% interest rate, okay? So if you plug this into a calculator, which I use our cash flow analysis matrix to do all my calculations in, I also gave us a 25-year amortization, right? And an amortization is, if you're going to be borrowing $375,000, the bank assumes that it's going to take you 25 years to pay that back. So they calculate the monthly payment on the 25 years. That's what amortization is. Okay, so 375K, 5% interest, 25-year amortization. This is going to give us our monthly payments. And I want to start off on this side. Principal and interest, and I'll call it P&I moving forward. So the monthly payment for P&I on this $375,000 mortgage will be roughly $2,181. Now let's break it down. The principal every single month will be roughly $634. So out of this $2,100 that you're paying, the first month, $634 is going to principal, and then this amount over here, the interest, will be $1,546 or $1,546. Now every single month that you make a payment, this will literally go up, I don't know, $2 or so, right? So on month 2, it'll be $636, and you get the point. And your actual interest, right, the amount that goes to interest, will go down by that same $2. So you'll see month by month by month, one will go up, one will go down, okay? Now let's do some quick math. So that was your monthly payment with P&I. After 12 months, after you've done 12 of these bad boys over here, you will have paid down, right? You will have paid down $7,790 on your principal. So if you literally do this times 12, you will have paid down, and it's not this exact number, right? Because remember I said it goes up every month by a couple bucks. But at the end of 12 months, you will have paid let's just call it $7,800 towards your principal, which means your $375,000 is now that basically $67,000. Your principal owing on that original loan amount is now this, okay? Now 24 months after. So after 2 years of doing, this increased, this decreased, after 2 years, you have now paid down, let's call it $16,000. So in 24 months, you've paid $16,000 towards this 375K, which gives you a new balance. Here's the new balance. Let's call it just shy of $360,000. I want to give you some quick math, okay? So that's the quick math, that's the breakdown. Let's say you did 2 years. I know I said 5-year term here, and follow me through to the end of the video to make sure that you understand where I'm going with this. This is 2 years how much you've paid down, okay? Let's flip over to the interest-only side. Monthly payment on the interest-only side is $1,563, and that is interest only. So I know it's pretty obvious, but every single month that you pay this, you are not paying any of this down. $0 goes to the principal. I just want to make sure to drive that point home so that people understand that. $1,563 every single month strictly goes to service the interest on that $375,000. Now the difference, here I'll go on this side. The difference on every single month, okay? So the $2,181 that I'm getting for the P&I minus the $1,563 that I'm getting for the interest only, some call it IO or interest only, okay? So P&I, interest only, IO, The difference per month is $618, 620 bucks a month in cash flow difference. All right. Now, after a period of 12 months, so after 12 months, we showed you exactly how much we paid down. So over here, 12 months, this is how much you actually made more in cash flow. Okay, so if you take this $618 times 12, this is how much more cash flow you would have made than you made on the principal and interest side. Okay, so let's strictly look at the cash flow. After 24 months, instead of paying down this much equity, you made this much more cash flow. Okay, so I just want to make sure we're all, so instead of paying down this $375,000 by $16,000 here after 24 months, you did not pay any of this off whatsoever on this side, but you made $15,000 more. And let's talk about the pros and cons of this. Let's break down this deal overall. Why did I say a 2-year term over here? Well, the way Mel and I like to purchase assets is in the beginning, we like to use creative financing. We like to use other people's money, none of our own, no joint venture partners. And this creative financing is a shorter term loan. It's more of like a bridge lending. So it's not like we're buying the asset and trying to get the financing that we're going to have for the next 25 years or 30 years, okay? We understand that we're getting into the project, we're getting into the asset, we're buying it, and we're going to be doing a BRRRR, right? Buy, renovate, rent, refinance, repeat. So we're not looking for 25, 30-year financing. We're looking for short-term financing, get in, buy the asset, lift it up, right? Reposition it, stabilize the asset, and refinance it. And during that short period of time, and for this example, I use the 24 months, the 2 years, I want to make sure that I cash flow. That to me is more important than the equity paydown. And hear me out, because at the end, at some point, right, and this is going to depend what's more important to you, is the monthly cash flow for the short-term stabilization period of the asset, is that more important to you than the equity paydown? Some people will say, no, Dave, you know what, equity paydown is what matters to me, that's all that matters to me. The place, it doesn't matter if it cash flows, I just need this to get paid down so every 5 years I can refinance. That's totally fine. Okay, that's completely fine. That's a hard play if you're using other people's money. The monthly cash flow is how Mel and I were able to quit our jobs right in our 30s. I used to be a full-time firefighter. She worked at the local college. The monthly cash flow play is what allowed us to quit. And let's continue here. Cash flowing highly every single month. This will make sure that you are healthy in the deal, right? If you're in a deal and you're just scraping by every single month, if something happens and you're not healthy in the deal, you're gonna go, right, belly up, right? A difference of $620 a month is huge, right? This deal is I'm not saying this deal is negative, this is just hypothetical, but this deal over here, if it's a good deal and it cash flows, it's making 620 bucks less every single month than this side over here. So in the grand scheme of things, I would much rather use creative financing, get into the deal, okay? Have the monthly cash flow, be healthy every single month in the deal, and then at the end of the 2 years or the 3 years, I just used 2 as an example, at the end of that period of time, once you've lifted the asset, which basically means taking it from here and lifting up the evaluation here through repositioning, stabilization, could be renovations, lowering the expenses, increasing the income. After that 2 years, I want to have lifted this $500,000 evaluation to, I don't know, did I make it worth 700K? Did I make it worth 650, 850? That is what I'm looking at. I'm looking at the bigger picture, I'm looking at the lift, and then I'm looking at the refi, okay? The refi is what I am concerned about because the refinance will take care of paying back that first mortgage anyway. Take care of paying back all the creative financing. And yes, I could have paid down $16,000 and I could have had $16,000 more on the refi. Yes, but instead I made sure to cash flow more and more every single month, and I made sure that my refi was big enough to be able to pay back, cover the $16,000, cover this, which I guess is embedded in that. So it's just a different play. And that's why when you're looking at, should I do a principal and interest loan or should I do an interest-only loan, you have to think about what your strategy is. If you're doing a 30-year, they probably won't give you a 30-year, but if you're doing a longer play you're probably going to go this route, right? And then if you're going a shorter term and you want to have higher cash flow and you know that you're going to sell the property, or you know that you're going to refinance it at some point and pay the money out, and the equity play is not really necessarily the most important to you, it's that monthly cash flow, then this one seems to be the true winner between the two. So in the end, there's no right or wrong. It just depends exactly what type of investment style you're into. Thank you so much for staying to the end. And if you like this type of video, check out our next one. I'm Dave from the Investor Dave Show, and I'll see you there.